and welcome everyone who's joining us now. Happy Grandparents' Day. This is the 11th annual Over 50 Fair. This year's virtual event is a charity conference benefiting the Inn. Thank you so much for spending your day with us. We hope you are enjoying the speakers as well as your weekend. We have a wonderful lineup of speakers to share with you today. Up next, our speaker is Dorsey G. Tague III. His talk is Reverse Mortgages Explained. His class is a complete education for seniors and their children about reverse mortgages, which includes information about what a reverse mortgage is, who is eligible, the process, the benefits, and what are the qualifications to receive a reverse mortgage. We will have many frequently asked question segments, plus address misconceptions that are associated with reverse mortgages. After a senior views reverse mortgages explained, they will have the knowledge on whether this financial tool can be utilized for their benefit for the later years of their life. I will put Dorsey's contact information into the chat. And now here's Dorsey.
Hi, my name is Dorsey, and I deal with reverse mortgages. And basically a little bit of background on me, and sorry for the confusion in the beginning here. I'm new to the Zoom universe. But basically, I've been offering reverse mortgages for the past 15 years. I'm a youngster at 65 years of age myself. And basically what we're going to be seeing today is we're going to see how reverse mortgages can be utilized by our fellow seniors. And the bottom line on these reverse mortgages is very simple. They are no different from a regular mortgage. With a regular mortgage, you have to make a monthly payment and if you don't make that monthly payment, the bank gets very displeased with you. With the reverse mortgage, it's still a mortgage, but you are not required to make that monthly payment. But if you wish to make that payment at any time for any dollar amount, you can. There is no prepayment penalty. So it's just really how it's being paid. Whether you make that interest payment every month or you do it in one lump sum at the end, either way the bank is getting their money. On another note here, I'm going to be showing you a copy of my TV show. It's about a half-hour show, and explains basically how the monies that a senior gets in a reverse mortgage, how they can utilize it for their later years of their life. So at this point, I want to start. I want to share the video with you, and bear with me on the bottom here. And I have an assistant with me, with Kathy. Come over here, please. Which button would I should be going with? Start screen. Thank you, guys. And then we're going to go over here. And oh boy, we're getting Zoom World. Share. And here we go. You'll find this show very interesting. It's not only educational, but there's a little bit of entertainment there. I do have somewhat of a personality, but it pretty well just tells you the deal about the reverse mortgages there. I may stop the show in between and just maybe add some highlights as far as what you're viewing. But again, it's something that I want everybody to make a decision of a reverse mortgage based upon facts instead of what they think it is or what other people are telling them. So this just gets rid of any confusion that one may have. And here's the start of the show.
You're still on camera. You have to be quiet and still. And then you can pause it and talk. You all see it? You're on. You got this.
Good day, everyone. Welcome to the show, Reverse Mortgages, a unique financial option. And I am your host and reverse mortgage specialist, Dorsey G. Tague III. Most of us have heard about reverse mortgages over the past years and have formed an opinion on what they are. And some of those opinions are correct and others are just misleading beliefs. Well, for today, we are going to clear up those misconceptions, and more importantly, we're going to educate you on the different ways seniors can utilize the funds that are available with the reverse mortgage. So let's get started with a simple definition on what a reverse mortgage is. A reverse mortgage is a special type of home loan that lets a senior homeowner convert a portion of their equity in his or her home into cash. A senior citizen who is 62 years of age or older is eligible for a certain percentage of money out of the value of their home, and whatever monies they take, they are not required to make any monthly payments at all. That's right, you heard it, no monthly payments at all. The loan not due until either the senior passes away, moves out, or sells their home. It's that simple. On a history note, the first government FHA insured reverse mortgage was completed in October of 1989. That's over 25 years ago. And on average, there are thousands of reverse mortgages funded each month, and over 1 million reverse mortgages have been issued since 1990. In reality, for many is their largest asset. Data shows that for seniors over the age of 65, home equity averages about 2.5 times the amount of their financial assets, and research has estimated that without the opportunity of tapping into their home equity, many seniors are at risk of not being able to maintain their standard of living during retirement. Thus, more senior homeowners and financial planners are now using reverse mortgages as a key part of their long-term retirement strategy. Here are some mortgages to help seniors meet their retirement goals. Let's start off with number 1. A senior can pay off an existing mortgage or home equity line of credit and eliminate their monthly mortgage payment. On to number 2. With a reverse mortgage, a senior can make retirement savings last longer by using the funds available in a reverse mortgage. Number 3, if the financial markets have a downturn, a senior can preserve their investment accounts by utilizing their reverse mortgage line of credit. We're at number 4. The reverse mortgage can increase a senior's income with a monthly predetermined reverse mortgage payment that is automatically deposited into the senior's bank account. Number 5, use the reverse mortgage line of credit to build a safety net for emergencies or home repairs and healthcare expenses. Moving on to number 6. With a reverse mortgage, a senior may be able to retire earlier or delay receiving their Social Security benefits so they can maximize their lifetime Social Security benefits. And let me put this statement into perspective. Let's say a senior was born between 1943 and 1954. If the senior starts receiving benefits at age 66, they will get 100% of their monthly benefit. If a senior delays receiving their retirement benefits after their full retirement age of 66, their monthly benefit will continue to increase each year, and here is your example. If a senior starts receiving retirement benefits at the age of 67, a senior will get 108% of their monthly benefit because they delayed getting their benefits for a period of 12 months. At 70 years old, a senior will get 132% of their monthly benefit because they delayed getting their benefits for a period of 48 months. When a senior reaches the age of 70, their monthly benefit stops increasing even if they continue to delay in taking their retirement benefits. On to number 7. A senior can buy a new home with the reverse mortgage that better fits their needs and wants. In general, a reverse mortgage can help a senior be prepared for any financial surprises of life. As many of us know, life rarely goes as planned. A reverse mortgage can be the cushion one needs to feel safe if something unexpected happens in the future. The proceeds from a reverse mortgage could help cover the costs associated with a poor economy, health and medical issues, or unexpected home repairs. Okay, let's talk in detail about the 6 different ways a senior can receive monies with the reverse mortgage, and they are as follows. Number 1, tenure payment. For seniors that are on a fixed income, well, now they have the opportunity of receiving a check for a certain dollar amount every single month for the rest of their life with the 10-year reverse mortgage program. And here is your example. Let's say a senior is eligible to receive a check each month for the rest of their life for $1,500 based upon the senior's age and value of their home. That senior will receive, as I stated before, a check for $1,500 each month for the rest of their life, even if they live to 120 years old, as long as the senior stays in their home. It is their primary residence. Pay their property taxes and homeowners insurance, the senior will receive that monthly payment. Another important point, we have a husband and a wife that have taken out a reverse mortgage, and in this example, they receive a check each month for $1,500. If the husband or wife passes away, the remaining spouse will continue to receive the monthly check until they pass away. Monthly payments will not end until both borrowers have passed away. On a side note, a senior may have a question that goes like this. This is great. I can get a check each month for the rest of my life, but I plan on living for a very long time. What happens if the amount I receive each month adds up to be higher than the value of my home when I pass away? If I have the opportunity of leaving a bill to my heirs, well, then you can forget about this reverse mortgage. And the answer to this question is as follows. A protection device has been built into every single reverse mortgage. As mandated by the Department of Housing and Urban Development, HUD, reverse mortgages are non-recourse loans, which basically means a senior could never owe more money than what the house is worth. And more importantly, a senior is not personally liable for the monies they take out in a reverse mortgage. The loan is based solely and only on the house value. And let me give you an example. Let's say when a senior passes away, their estate owes $300,000 on a reverse mortgage, but the house is only worth $250,000. Well, the heirs will sell the house for the $250,000, give the bank the $250,000, and the heirs and the estate are not responsible for the $50,000 difference. Remember, a senior could never owe more money than what the house is worth. On to number 2, term payment. For some seniors, wanting to receive a monthly check that exceeds what the senior is eligible for is another option. Basically, it is a fixed number of payments for a specified period of time, and here is your example. Let's say we have a 69-year-old senior who has a house value of $400,000 with no existing mortgage and needs an extra $1,900 each month to make ends meet. In this example, the 69-year-old senior with a $400,000 home value is eligible to receive a monthly check for about $1,000 for the rest of their life. But the senior is short the $900 of the needed monthly amount of $1,900. Well, a senior can get the term reverse mortgage program, whereas the senior can receive a monthly check for the $1,900, but the monthly payments would only last, in this example, for about 10 years. Basically, the more money a senior wants per month above what they are eligible for, the less time they will have to receive that monthly payment. Off to number 3, line of credit. Many seniors are on a fixed...
This one here, this line of credit, what a phenomenal tool that these reverse mortgages have that most people are not aware of. But we'll go over that at the end there. But this is just something that why a lot of financial planners are now, I'll use the word over the past years, are warming up to the reverse mortgage theory on making sure that a senior has the opportunity of staying in their house. Because who wants to leave their house? So on that note, we'll just continue with this. Sorry for interrupting everybody.
Fixed income that covers their basic monthly expenses, but not much more. When an appliance unexpectedly breaks or their home is in need of repairs, a reverse mortgage line of credit is an excellent way to meet such unexpected expenses. So let's go back to our example, whereas a senior is eligible for $200,000 in a reverse mortgage and has no existing mortgage, but needs monies to fix up their home and only would need about $50,000 to make the needed repairs. In this example, the senior can get the reverse mortgage adjustable rate program that offers a line of credit. Let's go back to the chart. As you can see, the senior is eligible for $200,000 in a reverse mortgage, but only needs $50,000. In this example, the senior can take out the $50,000 at closing, and yes, interest will start accumulating on the $50,000, and the $150,000 balance will be put into a line of credit established under the senior's name. No interest will accrue on the $150,000, and that $150,000 will always be there, and the senior can take monies out of their line of credit at any time they desire. The main reason why seniors would consider the reverse mortgage adjustable rate program that offers the line of credit is simple. Why have interest accrue on the monies that you are not in need of at the present time? Another unique advantage with the line of credit is that the line of credit increases in borrowing power each month. So a senior with $150,000 in their line of credit could possibly see thousands of dollars of additional funds added to their $150,000 line of credit after a year. The growth rate of the monies in the line of credit is determined by two factors: the current interest rate on the reverse mortgage loan plus 0.5%. And here is your example. Let's say a senior has a reverse mortgage with an annual adjustable rate of 3% and has $150,000 in their line of credit. The growth rate of the monies that is in the line of credit will increase for the coming year in the following fashion. The annual adjustable rate is 3%. You add 0.5% for a total of 3.5%. When you times $150,000 that is in the line of credit by 3.5%, it will equal to $5,250. So, after 1 year, instead of having $150,000 in their line of credit, a senior will have $155,250 in their line of credit. Plus, if a senior kept their $155,250 that is in their line of credit for another year, and the annual adjustable rate remained at 3%, after the second year, a senior will have an additional $5,433.75 added to the $155,250 for a total line of credit of $160,683.75. So, each year, a senior has the opportunity of having their line of credit increase, and what some seniors will do to supplement their fixed income is take out each year the credit line increase, which in this example is $5,250, which is noted for the first year, and keep the amount they originally started with, which in this example is $150,000, to increase again for the coming year. Remember, a senior can withdraw funds and deposit funds into their line of credit as often as they desire. By using the line of credit to build a safety net for emergencies, home repairs, paying property taxes, and healthcare expenses, it affords to the senior a level of monetary comfort that is needed at the present stage of their lives. Let's move on to number 4.
All right, just to pause this for 1 second here. Dorsey, I have a question for you. Okay, so I have a line of credit, and let's say I have $150,000 in my line of credit. I took out that $50,000. What if I wanted to pay into my reverse mortgage? Excuse me. What if I wanted to pay into my reverse mortgage $20,000 for an example? What happens to that $20,000? Excuse me 1 second, kids. So on that note, what happens with that $20,000, we'll pay that into the reverse mortgage loan. And obviously, when we do pay that, we're going to owe $20,000 less than what we had previously owed. Plus, the $20,000 goes into and back into the line of credit. So you have the opportunity of using some or all or none of that $20,000 again whenever you wish. And then the next question is, well, Dorsey, does that $20,000 that I'm paying back into the line of credit, is that also going to give me the opportunity where that also is going to increase where there's more money available for me each year? And I will say yes.
For lump sum payments. For some seniors, taking out the full amount of money, what they're eligible for, is an alternative. A senior might have a large expense that needs to be paid off, or have an existing mortgage that the monthly payment has become a financial burden. For those seniors that do have an existing mortgage, well, now they have a choice on how they can pay their mortgage off. And I'm sure you're all asking yourselves, what do you mean a senior can have a choice on paying off their existing mortgage? Well, here are your two choices. Choice number one is basically what a senior with a regular mortgage is doing right now. They can continue to make monthly mortgage payments to the bank that holds the mortgage, and that bank is dictating to the senior the rules on how they want to receive their monthly mortgage payments. The bank wants a certain amount of money each month due by a certain day. Now let's go to choice number two. Based upon what a senior is eligible for, they can possibly get a reverse mortgage. If approved, the reverse mortgage bank will pay off the senior's existing mortgage. Their history, done. And with the reverse mortgage bank, they will state to the senior that they are not required to make any monthly mortgage payments, and the loan is not due until either the senior passes away, moves out, or sells their home. Let's go to the chart. In generality, let's say a senior is eligible for $200,000 in a reverse mortgage based upon their age and house value, and the senior has an existing mortgage of $150,000. In this example, the reverse mortgage bank will take $150,000 out of the $200,000 the senior is eligible for and pay off the existing mortgage. The senior is now not required to make any more monthly mortgage payments. Plus, the reverse mortgage bank will mail a check to the senior for any additional funds they may be eligible for. Now, let's say a senior is eligible for $200,000 in a reverse mortgage based upon their age and house value, and the senior has an existing mortgage of $210,000. In this example, the senior is eligible for $200,000 in a reverse mortgage, but has an existing mortgage of $210,000. Well, either the senior comes up with the difference of monies out of their own pocket, which in this example is $10,000, or their senior cannot get a reverse mortgage. And on a side note, the $10,000 difference cannot be borrowed funds. Monies must be from either a senior's checking, savings, or investment accounts. Having a longtime friend or family member gift a senior the difference of monies is an allowable option. In essence, many seniors consider paying off their existing mortgage with a reverse mortgage mainly because of this simple fact. Even though a senior is not required to make any monthly mortgage payments towards their reverse mortgage, if they wish to make a payment at any time for any dollar amount into their reverse mortgage, they can. There is no prepayment penalty. Moving on to number 5, combination. With every senior, there are different needs and wants, and a combination of payment options may be the best alternative. So let's go back to the chart, and here is your example. We have a senior who is 69 years old with a home value of $400,000 and has an existing mortgage of $50,000 and is eligible for about $185,000 in a reverse mortgage. Not only does the senior want to pay off their existing mortgage of $50,000, but the senior also wants a check for $20,000 out at closing, plus a payment of $300 a month for 10 years, and the remainder amount of money put into their line of credit. And in this example, the figures would be as follows. The senior is eligible for $185,000, and from the $185,000, the reverse mortgage bank will pay off the existing mortgage of $50,000, plus the senior will receive a check at closing in the amount of $20,000, and also receive a monthly check for 10 years of $300. But more importantly, the senior has about $85,000 in their line of credit for future use if needed. And lastly, number 6, did you know a senior can buy a new home with the reverse mortgage? Well, they can. And this is great news for seniors who have a desire to purchase a new home, but didn't want to have to start making monthly mortgage payments at this stage of their lives. The Reverse Mortgage for Home Purchase program is designed to allow seniors to purchase a new home and never have to make monthly mortgage payments for as long as they live in their home. There are many seniors who are not comfortable with their present home as it no longer suits their needs. The kids have moved out and the house is just too big to maintain. The Reverse Mortgage Home Purchase program was designed to enable senior homeowners to relocate to other geographical areas so they could be closer to their family members or just downsize to homes that meet their physical needs, whether it be handrails, one-level properties, ramps, or wider doorways, and the list goes on. Basically, it all depends upon the senior's needs. Please take note that a senior will need to have their own monies available as part of a down payment on the home they wish to buy with a reverse mortgage, and more importantly, purchasing a new home with a reverse mortgage will not affect the senior's Social Security or Medicare. Plus, title will always remain in the senior's name. Here are 3 examples on how a senior can utilize a reverse mortgage for home purchase. Example number 1. Mr. Smith, who is 69 years old, wants to downsize and buy a home for $300,000. He has $250,000 in cash from the sale of his prior home, but does not want a mortgage since it will be a burden each month coming up with the monthly mortgage payment. Also, Mr. Smith does not want to put all of the $250,000 down on a new home purchase since it will deplete his cash reserve. In this example, Mr. Smith would be eligible for $135,000 in a reverse mortgage with no required monthly mortgage payments, and would have to come up with the balance of $165,000 at closing. But more importantly, Mr. Smith will have $85,000 left over from the $250,000 in cash for his retirement years. On to example number 2. Mr. and Mrs. Williams own their home with no mortgage and desire to have either an investment home or a vacation home, but will not qualify for a regular loan. Mr. and Mrs. Williams can get a reverse mortgage on their present home, buy the investment home or vacation home with the proceeds of the reverse mortgage, and have no required monthly mortgage payments on their purchase. But if they wish to make a payment at any time for any dollar amount, they can. There is no prepayment penalty. And lastly, example number 3. Julia is 72 years old and wishes to sell her home with $450,000 that she owns free and clear on Long Island. Julia wants to buy and downsize to a smaller home a few towns away for $200,000 to be closer to her children and grandchildren. She decides to use the reverse mortgage for home purchase program because she will have more money available for her retirement years by not spending the full $200,000 for the purchase of her new home. So after she sells her present home for $450,000, she can buy her new home and be eligible for $90,000 in a reverse mortgage and spend only $110,000 out of the $450,000 as a down payment. Now Julia owns her new home and she is not required to make any monthly mortgage payments. Plus, Julia is left with $340,000 from the sale of her prior home that hopefully lasts for the years to come. So as we have discussed and learned, a reverse mortgage can be utilized as a very unique financial tool, but let's not forget that a certain percentage of seniors will also have a need for in-home care during their lifetime, and paying for that in-home care can be very expensive. As costs continue to rise for prescription drugs, in-home care, and physical rehabilitation, seniors are having to shoulder a larger share of the financial burden or turn to their children for help. And while Medicare, Medicaid, HMOs, and private insurance will pay for doctor visits, hospitalization, and home care, these plans frequently require co-payments and may have insurance deductibles. Medicare does offer prescription drug coverage, but many plans do not cover related expenses that can help a senior cope with frailty, illness, or disability. Also, some seniors are in need of other types of in-home care. For example, someone to buy their groceries, or money managers to help organize a senior's bill-paying obligations, plus balance their checkbooks and sort their mail, and the list goes on. All seniors have their own unique needs and wants, and with the reverse mortgage, a senior can possibly have enough money to pay for their in-home medical and medicine expenses, plus have the monies to pay for other daily in-home care costs. As many seniors have already discovered, a reverse mortgage can be an excellent financial tool for generating the needed extra tax-free money to pay for their in-home care. Okay, in the beginning of the show, I stated we were going to answer some of the most common misconceptions of a reverse mortgage, and they are as follows. Number 1, if I take out a reverse mortgage, the lender will own my home. And the answer to this statement is false. This is the biggest misconception concerning reverse mortgages. Senior homeowners still retain title and ownership of their home during the life of the loan and can choose to sell their home at any time they desire. As long as the borrower continues to live in the home, maintain the home in average condition, and the property taxes and homeowners insurance are paid, the loan cannot be called due. On to number 2. I'm sure a reverse mortgage will affect my government benefits. And this statement is also not true. A reverse mortgage does not affect regular Social Security or Medicare benefits. However, if you are on Medicaid or SSI, any reverse mortgage proceeds that you receive would count as an asset and could impact Medicaid and SSI eligibility. To be sure, we recommend that potential borrowers consult their federal benefits administrators or financial advisors. Let's go to number 3. I can't get a reverse mortgage because I have an existing mortgage. And the correct answer here is false. If your home has an existing mortgage, the proceeds you are eligible for in a reverse mortgage will be used to pay off that existing mortgage. Remember, if you are short of funds to pay off your existing mortgage, you have the opportunity of coming up with the difference out of your own pocket. This is the most common reason why homeowners 62 years or older take out a reverse mortgage. We are on number 4. My children will be responsible for paying my reverse mortgage if I owe more than what the house is worth when I pass away. This is another common falsehood. Reverse mortgages are non-recourse loans, which means that a senior could never owe more money than what the house is worth when they pass away. Your children will not be responsible for any shortfall of funds if the reverse mortgage balance exceeds the value of the home. And number 5, I bet there are restrictions on how I can spend the monies I receive with the reverse mortgage. And the answer is, there are no restrictions. The cash proceeds from the reverse mortgage can be used for virtually any purpose, and borrowers should be cautious of lenders attempting to cross-sell other products. Many seniors have used reverse mortgages to pay off debt, help their kids, supplement their monthly income, or just have the peace of mind of having a financial reserve. We are at number 6. I'm sure I'm going to have to pay income tax on the monies I receive in a reverse mortgage. On this, we have another false statement. Proceeds received from a reverse mortgage are loan advances and are not taxed as income. And lastly, number 7, I can't get a reverse mortgage because I'm behind on my mortgage payments or in foreclosure. And on this statement, I will tell you, not true. As long as the senior is eligible for enough funds to pay off the existing mortgage, plus also be eligible for enough funds for set-aside amounts to pay for their future property taxes and homeowners insurance, then a home owned by a senior that is behind in payments or in foreclosure can be saved with a reverse mortgage. So there you go. Basically, a reverse mortgage is one of the most well-developed loan products in the mortgage industry. In over 50 years since its birth in 1961, reverse mortgages have been through many milestones to make it the safe financial tool it is today. I hope this show, Reverse Mortgages, a unique financial option, has been helpful in your education of reverse mortgages. I believe it is imperative that seniors be aware of all their financial options, and the option of a reverse mortgage may be the best financial option. Good day, all.
All right, there you go. Now I think I want to make sure. Okay, there we go. I'm getting a question. Is there such a thing as a partial reverse mortgage? Bear with me 1 second. All right, so is there a partial reverse mortgage? And again, any pausing that I'm doing for everybody here, it's because I'm unfamiliar with the toys that are presented to me. If I want a partial reverse mortgage, it's not that you can get a partial reverse mortgage. You can always get, you can only take out what you're, if somebody is eligible for, let's say $200,000 in a reverse mortgage, in the example that I had before, but they only wanted 50, well, they're not responsible to pay out that $150,000 that's sitting in line of credit. Is it going to remain there for them for the lifetime of the loan? Yes, it will. Do they have to take it? No. So for that question, that is not the case at all. There's no partial, but you don't have to take out all the money that you're eligible for. Important. We have two types of reverse mortgages in the reverse mortgage universe. We have the adjustable rate and we have the fixed rate. The fixed rates are right now roughly around, on average, anywhere from like the 4 to 4.5% on the fixed rate. But with the fixed rate, even though there may be an advantage with locking with your rate at that time, there's a downside where in some cases a senior will not be eligible for all the money that they would be eligible for if they got their adjustable rate. In some cases, they get 40% left. So if somebody was, let's say, eligible for $200,000 in an adjustable rate, in the fixed rate, they would be eligible for only 60% out of that 200, which is 120,000, and they would be forfeiting that $80,000 difference. But in this example, if that person is very happy with having only 120,000 in a fixed rate, then it's fine for them. But if that $80,000 is something that they would want later on, then it becomes important. Only with the adjustable rate can you have a line of credit. And the adjustable rates are right at the mark that you saw in the example of the annual being around the 3%. It might even be a little bit less as of today. Another feature that is being utilized and by financial planners and seniors themselves to make sure that one is able to stay in the house. As we all know, I don't know the scope of where everybody's coming from, but here on Long Island, my God, the property taxes are through the roof. It's unbelievable what it takes to live on Long Island. So years ago, about 4 years ago, 5 years ago, they came up with the LISA program with these reverse mortgages. And LISA, L-E-S-A, stands for a lifetime expectancy set aside. And based upon the senior, the youngster of the seniors, if we have a husband and wife, there's a certain amount of months that they will pay your property taxes and homeowners insurance. Example, somebody who is 62 years of age, their life expectancy in the charts that the banks use is maybe around 210 months left, where let's say somebody around 72 might be at 144 months. So on that note there, the LISA program was set up whereas basically a senior can have their property taxes and homeowners insurance paid for each year where they don't have to worry about doing that bill. And the money is automatically deducted from their reverse mortgage line of credit. And it just basically removes the burden of trying to remember if you paid your insurance and your taxes. As we all grow older, I think it's imperative to try and think less and have fun more. So to get rid of anything that you have to worry about, this is one aspect that it can be done. I have another question. In addition to the initial loan, what other charges or fees would be due when settling the reverse mortgage? You have your closing costs, which are, and let's be blunt with closing costs. The biggest pain in the tush with these reverse mortgages, in some cases, are the closing costs. There's one fee that has been incorporated since the first reverse mortgage was done in October of 1989, whereas that everybody and anybody who gets a reverse mortgage has to put 2% of their house value or, and here's the key line, or the FHA lending limit, whichever is lower, into the mortgage insurance premium fund. And the FHA lending limit is $765,600. So on that note, even though somebody may have a house worth $800,000 or $1 million or $10 million, doesn't matter. They can only get a percentage out of that $765,600, and that percentage can run anywhere from around 50 to 6% to be vague, but somewhat giving somewhat of a mark. So on that note, 2%. Everyone is required to put 2% of the house value or the FHA lending limit into the mortgage insurance premium fund. So if somebody, let's say for argument's sake, had a house worth $500,000, obviously 500,000 times 2% is $10,000. So one closing cost, just alone, is $10,000 for the mortgage insurance premium fee, which guarantees to the senior that they could never owe more money than what the house is worth. They could never leave a bill to their heirs. But in reality, my viewing audience out there, reverse mortgages would not be incorporated and be successful after 31 years without the mortgage insurance premium fee. Because in our example that you noticed before, whereas somebody owed $300,000, but the house was only worth $250,000, so they gave the $250,000 to the bank and they weren't responsible for the $50,000. The bank is not going to lose out on that $50,000. They're going to put their hand into the mortgage insurance premium fund, take their $50,000 out to make themselves whole. The banks love these reverses because even though they don't know when the heck they're getting paid, even though they're giving out very low interest rates, they're guaranteed to get every single dime that's owed to them when the loan does become due by either the selling of the house or the selling of the house. And if it's short, they can dip into the MIP fund to make themselves whole. So basically, the biggest pain in the tush on these reverse mortgages is that one fee. And then all your other fees, your normal fees, whether it be title insurance, recording fees, which in Suffolk County, Nassau County, is like $1,500 to recording now when it used to be $500. But either way, you got your recording fees and your normal fees that are involved in any type of a mortgage. Another question we had, so if I don't take out the entire line of credit, what happens to the balance of the unused reverse mortgage loan? As I stated before, the charges, any money that you keep in the line of credit increases each year on average in the example that I gave of 3.5%. So if somebody had $150,000 in their line of credit just sitting there for the whole year, well, after 1 year, it's not $150,000 anymore. It's $155,000 and change after that. And then if you roll that 150 over 5 over for the following year, then you're up to about 162. What a lot of seniors will do that are not in need of a reverse mortgage right now will get the reverse mortgage just to use the line of credit increase, because nowadays, where can you get a 3.5% increase on your money, which is safe? That's the most important thing. At our ages, you don't want to invest into anything where you have the opportunity of losing. So they will start getting the reverse mortgage and let it just keep on rolling over. So this way, when and if they do need it, they have more money in there than what they started off with. Let's see if we have any other questions here. We're coming up towards the end. And bear with me 1 second here. Couple did you know questions there. Well, we know about paying your property taxes and homeowners insurance. And we know about you never could leave a bill to your seniors there. Another thing which was not stated before. So let's say a senior passes away, and in this example, they owed $250,000, but the house was owed $300,000. If a relative or a family member wishes to buy that house back from the bank, or no, I'm sorry, that's a poor wording there. If they wish to refinance the loan from the reverse mortgage to a new loan, the bank will then require that they only have to pay what the value was of $250,000, but they also give a 5% discount. So instead of having to come up with $250,000 to buy the house back, you times that by 95%, they come up with $237,000. So in regular words, even though we owed even though we owed $300,000, you can buy the house back for $237,000 if one of the family members wanted. And with any type of a loan, the bank does not own the house. And let me even back up a little bit here. On these reverse mortgages, they're very simplistic. It will not affect your Social Security. It will not affect your Medicaid. It will not affect any STAR program that you're in or any other benefits that you're getting. It is tax-free money because it is a loan. It is not considered income. So on that note, Any money that you get with reverse mortgage, you can utilize it in any fashion that you wish. Let's see, let's see what else I have here. And I think we're just about done there, my viewing friends. And I think I had stated this also, and I'll just repeat it there. Dorsey, I have a question for you. I'm 62 years of age. My wife is only 59. Can we get a reverse mortgage? And I will say yes. But now here's the kick. Here's the kick here. So yes, so the reverse mortgage will be under the husband's name, but also the wife's name also, where she will be, since she's under 62, they will put her in as an eligible non-borrowing spouse, which means that the house would only have to be titled to the husband. So if the wife was on before, she would have to come off. The husband would then just be on title. But if the husband, since she's eligible non-borrowing spouse, if the husband passes away ahead of her, she has the opportunity of coming back on title and then writing out his or her reverse mortgage till death does she part. But any monies that are in the line of credit at that time will not be eligible for the eligible non-borrowing spouse. So there are a few restrictions. It used to be prior, years ago, where for an educational part, that you had a husband, 62, getting a reverse mortgage, the wife was taken off, and he passes away, and the loan officers were not telling people that, well, now the wife has to get her own financing now to pay off what her husband had. And sometimes the wife would not be eligible, and even if the husband, if you switch it around, would not be eligible to do that, and then they become displaced. So they changed the rules of the game years ago to make it so this way nobody's being displaced and that everybody's protected. Well, I think we're pretty well set. I hope I was helpful for everybody here, and I apologize and I thank you for giving me the opportunity to learn about this Zoom stuff, this Zoomage. And you have my phone number there. If anybody has any questions, you're more than welcome to call me anytime or text me or email me or whatever the case may be. But I thank everybody for listening, and hopefully we chat again. Thanks.